Thank you for being with us today. So I will take the first question of the segment, which is about balanced advantage funds. So basically, the question is around how balanced advantage funds are taxed. And there's also a question more specifically about the ICICI Balanced Advantage Fund, which is treated as an equity fund in terms of taxation, in spite of having a 40% allocation to equity. So just to quickly answer this question, balanced advantage funds are required typically to maintain a minimum of 65% in terms of their equity holdings, which translates into an equity kind of a taxation for all taxation purposes. Even though they do hold some amount of debt as part of their portfolios, fund managers typically tend to hedge their positions even if they go lower than 65%. And bring their equity exposure thus to a gross holding of about 65%. So largely, these are taxed as equity funds rather than as debt funds. And because of this, they also get an advantage of equity taxation, which is much lower as compared to what you would do in a debt fund. So I'm hoping that answers the question.
So the next question I'll take up, that is from Mr. Anand Kumar. He says that if I want to buy index fund, is SIP advisable or lump sum investment? Now, Mr. Kumar, if you are investing, irrespective of whether it's an index fund, which is a passively managed fund, or a diversified equity fund, which are actively managed fund, SIP continues to be the advisable mode of investment. SIP, the reason are two. Obviously, Group E cost averaging is one of the reasons, because these are market-linked instruments, whether index fund or a actively managed fund. They all are market linked, so obviously you need to get invested in different points in time. That is what SIP helps you to do that. The other aspect is obviously the disciplined investment approach that SIP inculcates into your investment pattern. Now, coming to the lump sum investment, there's no stopping anyone to not invest lump sum. Even if you are continuing with your SIP, as and when you have more money to invest in, you can do a lump sum investment as well. Or you can start fresh SIPs in other funds which are more apt in terms of your risk appetite and asset allocation. So if the question is, SIP is advisable for equity investment, yes, SIP is advisable for equity investments. But obviously, if you have lump sum money at any given point in time, you can also do that, continuing with your SIP.
Sure. Thanks, Himanshu. There's another interesting question from Vivek Raut, and he's quoting some data from NSE, where essentially what he's saying is about 38 lakh investors have left the market in the last 6-7 months. And he wants to know, do you see this number increasing, right? So and the reason why I want to address this is very important from a investor behavior perspective, right? So when we saw the COVID pandemic, a lot of new investors came to the market. And, when we had this sharp rise in the markets, the feeling on the street was that I don't necessarily need a professional money manager, because I can just, literally, pick any stock and it's going to run up, right? I mean, that is the experience a lot of the newer investors had in the market. And I'm just going to quote some data. This is slightly dated, but it'll kind of, drive home the point that I'm trying to make, right? So when you look at the BSE 500 returns somewhere in the month of November 2022, the 3-year CAGR was north of 18%, right? Excellent returns for a 3-year period. But when I break the constituents of the index down, the 500 stock holdings down, what we see is that 1/4 of the stocks, about 25% of the stocks during that 3-year period actually gave a negative return. Close to about 35% or 1/3 or more, about 1/3 of the stocks couldn't beat debt returns during that time. And remember, debt returns themselves were quite muted, right? 2/3 of the stocks didn't beat index returns. So which means that if you're trying to do individual stock picking, it's going to be a very hard exercise. It may work for you at some point of time, but unless you have the wherewithal to do your own research, spend time, figure out entry, exit valuations, it's an exercise that I would advise most investors not to do. The best thing to do, we have an excellent, well-managed, professionally managed mutual fund industry, which is very well-regulated, transparent. And I would urge each of you all to consider to make your long-term investments through these. So to the specific question, it may be a case of investors having had misplaced expectations coming in through direct equities and then exiting because the markets have obviously been choppy for a while. But again, I would urge everyone who's thinking about investing in equities or fixed income for that matter, mutual funds is a brilliant tool to do that, to meet all your financial goals. And I would definitely want you all to consider that as the foremost option when it comes to investing.
We also have a question about the Morningstar ratings and about how frequently these are relooked at or revisited. So to give you an idea, we have different kinds of ratings. We have a star rating, which is essentially a 1 to 5 star rating. It's a backward-looking rating, and it's based on the fund's past performance. Now, star ratings are calculated at the end of every month using the NAV of the fund, of each fund that we look at. And this gets rebalanced or recalculated on a monthly basis. We also have a Morningstar analyst rating, which essentially ranges from gold to negative. So these ratings are forward-looking, opinionated ratings, which are put out by analysts. They essentially demonstrate an analyst's conviction in a fund's investment and investment philosophy and the merits of it. These are typically evaluated on an annual basis. But then again, if we find that there are any changes in terms of a fund's manager or the process, any change that warrants a relook at the fund, we will tend to kind of revisit the fund in the interim, even if it's not due for an annual review at that point of time. So these are largely how we look at the two ratings and how frequently we evaluate them. We also have a quantitative quantitative rating, which is again ranging from gold to negative, and these are calculated on a monthly basis. The sustainability ratings, which are also called the globe ratings, are also calculated on a monthly basis. So except for the analyst ratings, all the others are actually looked at on a monthly basis.
Thank you, Kavita. The next question is from Mr. Jitendra. He says that, is it correct to say metals may give better returns in these 3 years than equities? Means I think what we need to really understand is predicting a return from a volatile sector like metals is really, really difficult. It's a specialist job. And that is what, if you recall my presentation that I made, I think sector funds and thematic funds are largely meant for those investors who have the ability to, track the segment, track the sector, make their entry and exit into that, and normally track what are the dynamics or what are the factors that are impacting those sectors. If you look at metal as a sector, means I'm not a metal expert, I'm not a sector expert, but it's a volatile sector. It's not only domestic demand that drives this sector, but it's also the global demand that have a huge impact on the performance of this sector. To avoid these sector deviations or sector rotations that happen so frequently, that is where we always recommend investors to go for diversified equity fund if they don't have the capacity and wherewithal to actually track the sector and the factors that are impacting. Over a 3-year period, it's very difficult to even comment a sector like metal, how it's going to do over a 1-year period or 6-month period, because the things changes so frequently. So I think rather than tracking a sector or taking a call on a sector how it's going to do 3 years, we should rather put our faith on someone who is an expert, who is tracking all the sectors, who has a team in place, which is the fund manager, who has a team in place. He has sector analysts who are tracking, and he can time his entry and exit in a sector. And if there is an opportunity in metal sector that can be captured, the fund manager will be better equipped to capture those opportunities rather than we as an individual who doesn't have enough bandwidth as well as knowledge behind us to take that decision.
Thanks, Himanshu. And I think there are a whole host of queries around what's happening and been in the more recent news about obviously the Adani Group. What's the impact on the equity markets in general. So I think we have to really think about it from the context of, so again, I'm not going to specifically talk about the group of the issues. I mean, that's obviously something which the regulators are looking into. The capital markets are also have kind of voted for that. But I think the moot point being that India, when we talk to the local fund managers, the international fund managers who are allocating to India along with other emerging and developed markets, India is a great growth story. Very well established industries and management. Obviously, I think Dan touched upon that valuations on a relative basis might be slightly more expensive, given that we were more resilient in 2022. But I think we shouldn't really be perturbed by one sort of incident. I mean, jury's still out on that, but about certain of these issues that. I mean, these will crop up in every geography or market. We don't really need to really focus on that. I think the important point is, to continue with your investing journey, not worry too much about the noise that will continue to come through. Probably gives you a good opportunity when the market's generally corrected because of some of the negative news flowing, to top up your equity exposure. And we talk about asset allocation, the importance of that. It's important to continue to kind of hold those views and continue with your asset allocation over longer periods of time. So I think that's really the moot point. Not worry so much about very, very company specific incidents, so to speak.
Thanks, Kaustav. So we also have another question from somebody who's anonymous, who wants to know how long is long term, and how, so for somebody who's invested in the market at a very young age, when should they start and how should they start? So I would like to start answering this question by using a statement which is very famous. And it goes like this, that time in the market is more important and more relevant as compared to timing the market. So to kind of take the conversation further, and also from what Kaustav touched upon a little while earlier to answer his previous question, I think it's really important for any investor to understand that firstly, the younger they start their investments, say when they start earning their first paycheck, or when they have enough savings to start their first investment, that gives them that much more time in the market to kind of understand, learn, and also to correct the mistakes that they've made. And of course, the longer term that you remain invested in the market, it gives you that much more returns in terms of the averaging out principle, because markets have remained cyclical in the past and they will continue to do so in the future. What's important is for us to understand that the cyclicality is a part of the whole process. It will come with a part of the investment that we have made. And the averaging returns factor is what is most important to us when we are looking at investments. So again, it's important that we look at how long we remain invested in. I would typically say about 5 to 7 years is largely where you would look at from a long-term perspective. But then again, it's also important to rebalance the portfolio and to ensure that your portfolio is meeting your long-term goals rather than just remaining invested and then forgetting about your investment. So that's again, another point that I want to make on this question.
Thank you, Kavita. We have a question from Mr. Umesh. There are a couple of questions, in fact. How we can know how many strategy fund manager is using, and how to know that what market conditions which strategy will do good. So frankly, if you want to know how many strategies the fund manager is managing, I think one of the way to do is to get the fact sheet. The fact sheets of all the funds, how every fund house come out with a monthly fact sheet, and it gives the name of the fund along with the manager who is managing it. It's an easy way to do it. You can go through that fact sheet and find out, if you are looking at a particular manager, how many funds that manager is actually managing. There could be multiple managers as well. So at times it becomes difficult to actually find out who is the lead manager, because there are certain few managers who are co-manager. But normally in most of the MCs, what we have witnessed is that the first name manager is the lead manager, but that could actually vary from fund house to fund house. So that aspect you need to keep in mind. The other question, in what market condition a strategy would work? So how do you find out that? So if you look at Morningstar style box, there are sections in Morningstar style box. One is large, mid, and small cap, which tells you which market segment the fund is investing. So if it's a large cap and there's a large rally in mid and small cap, then you can actually understand that, okay, in the rally, which is mid and small cap segment, large cap would tend to underperform that rally. If fund is from say a flexi cap category, where the managers have leeway to go anywhere within the market segment, in a mid and small cap rally, the fund which has higher large cap allocation may tend to lag the funds which have higher mid and small cap allocation. But again, the other aspect is based on the investment style, that is growth, blend, and value. Now, if you look at, again, in my presentation, I did give an example of how the markets have behaved since 2018 until now. 2018, 19, 20 were the markets where growth style of investing was in favor. The managers who adopted a growth style of investing actually did well, and the funds which were run with valuation conscious investment approach, they typically struggled. But then that cycle reversed towards the end of 2020, and since then it's a value driven investment approach which is doing well. So value funds are in favor. So if you know which segment the fund lies, say for example large growth, then you would have, if those funds are underperforming now, you shouldn't be too worried as long as the fundamentals of the funds, the other aspects that we look at stays intact. This is a cycle. And when there will be a rally in the growth oriented segment, these funds will again do well. There is another question which states that wish to understand the significance of different colors in style box. For example, dark blue and light blue boxes, how to read them. Now, where the higher concentration of the stock is, that segment in the style box will be dark colored. So if it's blue, it will be dark blue. For example, if you would recall my presentation where I have shown the style box of Nippon India large cap. If you don't remember, you can go on the website and you can check that as well. The 63% of the weight is in the blend section. That is large blend. And that section is dark blue. So where the higher weight of the stock is, the segment, that will be dark, and it keeps on getting lighter as and when the allocation keeps on reducing in different market segments. So that is how you can read that.
Sure. Thanks, Himanshu. So there are a couple of questions, one from Abhay and from Mr. S.K. Sharma around, our sort of ratings and what do you do when a fund rating drops? Mr. S.K. Sharma asked that, whenever I invest in a 5-star fund, if fund performance starts decreasing due to mean reversion, is it better to invest in 4-star rated rather than 5-star rated funds? So that's an interesting sort of, question. Let me address, 2 parts to it, right? So the first thing is when you think about the star ratings, and I think the most important thing to acknowledge is we believe that these are good shortlisting tools for investors to use, but should not be the only decision-making tool while picking a fund, right? Because for whatever, we have a pretty robust system in terms of risk adjustment, but eventually it is based on past historical risk-adjusted returns, right? I mean, there's no taking that away from the star rating system. And that's why we've develop the analyst rating system, which is more forward-looking, and where the analyst puts out conviction that we think that a fund is can do well over a long-term risk-adjusted basis, right? Now, specifically, if a fund falls off because it's very specifically targeted towards the star ratings, the first thing that we've seen, given our star rating methodology, we don't expect very sharp drop-offs in short periods of time because we look at long-term track records and we do an adjustment only if a fund's got extreme downside volatility. Where a fund would be heavily penalized and would come down the pecking order. That's where a fund could come down sharply, but those cases will be few and far between. So that's the first thing, right? The other thing, and more importantly, look at from the why is that fund being held in your portfolio, right? So even if, say, the past historical performance has dropped, what you need as an investor need to evaluate are 2 things. What is the purpose of that fund in your portfolio? And has anything materially changed in terms of, the fund, be it the fund manager, the investment style? Himanshu in his previous response very nicely touched upon, how do you analyze the strategy what the fund manager is following in terms of his or her style? You can do that through historical style boxes to evaluate that, is that drift in performance coming because maybe the fund manager's changed the style, or it's only because it's going through temporary cyclicality in terms of just the style being out of favor, right? Like Himanshu spoke about that, growth was the darling of the market, and in the years of 18, 19, 20, value was unloved, and that tire has changed in the last 2 years, right? So I think that's the analysis that you need to do. And secondly, and more importantly, we spoke about what is the fitment of that fund within your portfolio. Because what happened and what we observed was that a lot of investors gravitated towards a certain segment of the market based on past performance, right? So, for instance, when growth funds are doing well, many investors held only growth funds in their, portfolios. Or now currently when value funds are doing well, everyone's kind of moving towards value. We would advise against not doing that because then it becomes a feast or a famine situation, right? So if you're buying only growth funds, your portfolio will be significantly underperforming as a whole against the market, against your peers, simply because you're only kind of tilted towards one style, right? So the best way of doing it and positioning a fund in your portfolio is if you can blend both of those in your portfolio. So you buy a growth style fund, you buy a value style fund, and you know that there are going to be periods where that fund could underperform. And that's the way you would want to play it. So while the ratings might move an inch here and there, I think what's important to assess is that what is the trigger for the rating? Is it still doing what it is supposed to do? And that's how you can hold conviction or take a sell call on the portfolio. I think that's what you need to keep in mind when you're looking at it from the context of the ratings.
Sure, thank you for that, Kaustubh. We also have another question from Mukta who's talking about international mutual funds that have held international exposure, like SBI focused and PPAF funds, for example. They haven't been doing really well for the past 1 year, and her question is whether she should hold on to these or whether she can expect these funds to do well in the future. So just to give you some more perspective, and also drawing from the previous points that Kaustubh and Himanshu have put across so succinctly, the funds happen to do well. They are cyclical in nature, and one of the reasons why these funds have not done well in the past 1 year is because of the macro issues that have been related to the US markets, fears around recession, the inflationary pressure that the markets have been facing, and things like that. But it's important to understand that these markets offer a very good perspective from a diversification perspective for investors. So investors who want to diversify their portfolio across other markets, they offer a very good opportunity for them. And we always recommend that these should not, the exposure towards international stocks for any investor shouldn't be about, say, more than 5 to 10% of the overall portfolio. Having said that, given that they haven't done well in the past 1 year, it doesn't mean that you should exit these names, because as the markets face a turnaround, they will kind of tend to start looking up again. And India as a market has been outperforming other markets on an overall basis over the past 1.5 years. So we've seen that trend, and we've seen the kind of flows that have been coming into the Indian funds. But that doesn't mean that you just exit a fund because of a short-term underperformance. Like Kaustubh and Himanshu pointed out earlier, it's important to diversify and hold, say, multiple styles across the portfolio, so that the additional risk that you take in one segment of your portfolio is kind of balanced out by the kind of lower risk that you take in another section of the portfolio. So that's, I think, hopefully that answers your question, Mukta.
Thank you, Kavita. The next question that we have is from Mr. Satya. He asked that, does AUM for the specific fund is a critical criteria? Is lower AUM indicates good growth potential in future? So let's take first question first. Does AUM for the specific fund is a critical criteria? No, it's not a critical criteria, but in some cases, like in case of small cap funds, it can be a criteria. Listen, where does AUM impact comes into picture? It's largely based on the capacity constraints, which means that the manager is not able to find, given the liquidity crunch in that particular segment, the manager is not able to find enough opportunities to invest in terms of, and having the right weight in those stocks, because the liquidity is low, the market capitalization could be lesser for that particular stock. He might not be able to size up those positions. This concern or this risk largely plays out in a small cap segment. In the large cap and mid cap segment, we have not yet seen funds facing capacity issues based on AUM growth. In the small cap segment, there are few funds in the past who have actually restricted or soft closed the flows into their funds, largely because they were facing capacity constraints. They were facing challenges in terms of getting the right stock at the right price, as well as sizing up those stocks. So in a small cap segment, definitely it becomes a criteria. But then that is also a factor wherein what the manager's skill set is. There are few managers who are still able to size up within the limited liquidity constraints and still deliver outperformance. So that is a bit of a qualitative as well as a quantitative factor that you might have to look at before actually saying that whether the fund has a capacity constraint or not. Currently, there's just one fund, I think SBI Small Cap, which has soft closed assets. Other funds, they have soft close in the past, but now they are open for fresh investments. Is lower AUM indicates good growth potential in future? Not necessarily. The potential for generating returns is almost the same for smaller funds as well as larger funds. It depends on how much allocation you have, what kind of a bets that you are taking. Are you right in taking your stock calls? Is your stock calls working? That is where a maximum growth and performance comes into. AUM does not really indicate much in terms of performance. Again, in small cap, that could be a factor, because if the manager is not able to size up his investments, given the challenging liquidity condition or a small market cap of in a particular stock, he may find it challenging to exit a stock where his calls are not working because the liquidity is low, and that could actually impact the performance. right? But otherwise, AUM doesn't really play too much of a role, or small AUM or higher AUM doesn't really play too much of a role in the growth potential of a fund.
Sure. Thanks, Himanshu. There's a very specific question from Mr. Yashpal Gupta. And firstly, Mr. Gupta, kudos to you, because what I'm reading really, is very impressive. So, Mr. Gupta is 69. He's drawing a handsome pension. He's already got a significant retirement corpus that's built in. His children are well settled. He's actually gifted his grandchildren about 40% of his corpus. His medical is taken care through medical insurance. So his question is, can I take equity or limit to balance advantage funds, right? So the first, thing I want to clarify is that many people think that, equity allocation is linked to age, and the older you grow, you should limit or not take equity allocation, right? Remember, it's always only a thumb rule. It's not necessarily always the holy grail. It depends on your financial situation and conditions at that point in time, right? So I think for instance, in Mr. Gupta's case, because he's drawing a pension, so I'm assuming his monthly expenses and probably overheads are very comfortably taken care out of his pension. He's already got a significant corpus in place. The only thing I would advise is two things. One is that while he's got medical insurance, he needs to keep away an emergency fund any which ways, which also takes care of emergency medical expenses, which may or may not fall under the the medical insurance realm, or if he has to exceed certain limits, right? So that's a very important thing to do. Beyond that, he can definitely take exposure, at an asset allocated level to both equity and debt, and it could potentially be through balance advantage fund, despite his age, where most rules would tell you that you should be very limited to equity. I think the propensity or his ability to take risk in equities is reasonable. So where he can actually grow his wealth over long periods of time and leave a legacy to his heirs. So definitely, depending on the situation, I think it makes sense for him to take kind of a balance advantage exposure, where he has the comfort of an emergency fund for unforeseen expenses. At the same time, he can enjoy the equity returns over a long term. So that's very important to keep in mind. That rule of thumbs are only a rule of thumb. You need to look at it from a very individual perspective when it comes to allocations. There are some additional questions that have come in through on asset allocation. So I'm just going to quickly just look at them and address them. So there's a question about, this balance advantage funds or multi-assets fund, which is a good strategy for lower drawdown in a portfolio as compared to index investing. So obviously, see, when you think about a balance advantage fund, right, by design, what it's trying to do is, there are various funds that run with different models. So that's also important to assess. But essentially, the primary design of a balance advantage fund is to look to reduce equity exposure when markets are overheated. If you look at the say pure valuation-based metrics that a lot of balance advantage funds would run on. But even fundamentally, they could adjust if they think that fundamental, sort of prices have run ahead of that, right? So that kind of auto adjusts your equity exposure to equities, if equities are expensive. But the important thing to keep in mind is that a balance advantage fund will obviously do what its model tells it to do, but that is not a fit for every investor in the sense that it cannot be the only fund in your portfolio, because every investor will have his or her unique needs in terms of asset allocation. So it can definitely be a part of your portfolio, but shouldn't be the single holding in your portfolio thinking that I'm just going to mirror that. Because remember, equity is a great long-term asset class. And if you have a long-term horizon, you want to still be largely allocated towards equities, whereas a BAF could even go down to say 40% of the short term to equity. So you want to hold that in a proportion of your portfolio, not being your entire portfolio, right? A multi-asset fund, in that sense, will bring in an additional leg of asset allocation, be it through gold or REITs or InvITs. So it just adds that additional little bit of element of diversification. Definitely, again, the same fundamental holds for multi-asset funds, where you could potentially add them to your portfolio if you want to take exposure to those funds. You could also do it just by directly buying gold. It depends on each and every individual propensity to do that through an asset allocation model, either through a fund or directly buy those individual funds in your portfolio. So I think that's a call you need to take. If you can't do so, definitely take the advice for advisor who will help you understand your situation and then kind of guide you to the the right allocations that exist.
Sure. Thanks, Kaustubh. There's also another question that's come in from Omkar Vadhavkar, basically asking us if it's easier and better to invest in lump sums versus making an SIP investment. So I just want to kind of touch upon the benefits of lump sum versus SIPs and talk about why the pros and cons of each of them. So to start with, talking about SIPs, these are regular payments that you can make into a particular fund of your choice or a portfolio of your choice, depending on what kind of portfolios or funds they are picking. Now, the benefits of these are that these are you can start with really small amounts, and you can make this as a, every time you get a set income that's coming in based on your income flow, you can time your investments, and you can kind of pick and choose what you want to invest in, how much you want to invest in. And SIPs give you the benefit of averaging out returns over a long term. Whereas when you make a lump sum investment, you have to ensure that you are investing at a time when you are able to get benefit out of making that investment. Oftentimes, people think that making a lump sum investment in a down market, even if a fund is performing well, could be beneficial, and it would give them a lot of upside to only see that the cycle turns immediately after they make the investment. So rather than trying to time a market and make a lump sum investment, depending on how you view the markets, it's important to make sure that you use a goal-based investing approach, even if you're making a lump sum investment. So it's really up to the individual in terms of whether they want to make a lump sum or an SIP. An SIP really helps if you want to make a consistent kind of an investment based on your level of income as well.
There's one question from Mr. Pawan. Nowadays, most of the mutual fund having high churn ratio. Why this case happening with most of the mutual fund, and what is the reason for this? Now, the churn in the portfolio could be for multiple reasons. Let's take, for example, a manager who is a momentum-driven manager. A momentum-driven manager will try to churn the portfolio because that is what his investment style is. He will get an opportunity, he will invest, and as and when his target price achieved in a particular position, he will exit that and he will go into another fund to get another stock to get the best opportunity out there. Then if you look at the markets over the last 2-3 years, the markets have been extremely volatile. In most of the cases, like for a value oriented or valuation conscious manager, the price points that they would have targeted for the stocks would have reached quite earlier than it used to be in the previous time when the markets were more rational. So once those target prices are achieved, the manager would try to rebalance the portfolio towards more better investment opportunities, because in the investments that he has already made, he would have actually valuations. Those stocks would have actually breached his valuation targets. So that could also be one of the reasons why the churn in the portfolio could be higher. Another reason is in the past, since 2020, towards the rally that we have seen post-COVID, there have been a lot of sector rotations. There were pharma stocks which were doing well, then IT sector started doing well, and then other sectors which keep on changing lanes, and one sector underperformed, the other sector start doing well, and there were managers who try to capture those changes within that, and that could also be one of the reasons why the churn in the portfolio would have gone up. But still, if you look at those old school managers who have traditionally followed buy and hold kind of an approach, we have checked the turnover ratios in their portfolio, and they are still at the same sort of level than that it used to be earlier. So in some cases, yes, the churn in the portfolio would have gone up, but broadly in those managers who doesn't have follow a momentum-driven investment style, these things wouldn't have the turnover ratio is still at a very reasonable levels.
Sure. Thanks so much. So just the last few questions that are through. So there's a question from Surya about the Russia-Ukraine war affecting the market, and war is obviously stretched beyond what a lot of people on the street thought would and still continues. So the question is, will the war extend further and turn into a world war, and what will be the condition of the Indian market in the future? Right? So I think it's one is, I'll be honest, I'm no defense expert, and it's very hard for anyone to predict about how these geopolitical tensions play out. They have been around for a while. You talk about Russia, Ukraine. There's also the murmurings of China and Taiwan. We've had such instances in the past. So it's very hard to call when that's going to end and when that overhang will go away. But I think what's important, what history's taught us, is that as long as you as an investor have the right time horizon, right, especially for a asset class like equity. So it can happen, and it's happened in the past that, markets go only sideways for a couple of years, and then suddenly there's this pop in the market, a significant pop in the market. We saw that in the Indian markets, just prior to 2014. For a very long time, they didn't go anywhere, and then election results, and boom, the markets ran up quite significantly. Right? So the point that I'm making is, you as an investor, your job is to allocate according to your asset allocation or your needs for your goals, and not really worry about these extraneous events. The professional managers will look at, if there's something like this happening, where should they be allocating in terms of sectors and geographies, if it's a multi-country fund. But your job as an investor is like, okay, this is my goal, this is my investment time horizon, this is the level of risk I'm okay to take. That's what really should be your sort of decision set. Not really worry about the rest of the noise. I know it is perturbing. There's that will always come in, but we should try our best to avoid that noise as an investor, because that's how we will end up achieving our financial goals, by investing in a systematic fashion, rather than worrying about this external noise. It could be an overhang for longer. We don't know, right? But like I said, the point is, stick to your goals, and I think it'll pay off for the long term.
Thanks for that, Kaustubh. We also have a question from Raghu, which is very specific to the Pigeon Equity Global Opportunities Fund. So he's asking if he should continue to stay invested despite the fund's underperformance. The reason why the fund has underperformed is because of its exposure to the global funds. It's basically a fund-to-fund structure which invests in overseas funds. And we have seen that the markets like US and UK have not been performing really well over the past year, which is why we've seen a lot of funds with international exposure underperform in 2022. But having said that, I think it's too early to take a call to exit the fund, because like I also mentioned this in one of the previous answers to the previous queries, that it's a part, the whole exposure that you take to a global equity sector is a part of your a part of the diversification process of your portfolio. So the idea behind taking international equity exposure is to ensure that your portfolio remains diversified, and this forms a fairly smaller percentage of your entire portfolio. So ideally, it should be about 5 to 10% of your portfolio, and not more than that. And from a diversification perspective, and from a balancing out perspective, you should always ensure that a higher risk that you take in one segment of the portfolio, in this case, international equities, for example, should be balanced out by the other section of your portfolio, which is either domestic equity funds or debt funds in this case. So I hope that answers your question, Raghu.
Thanks, Kavita. So I think, we've kind of, there's some associated questions around, obviously, the capping of RBI's limit in terms of, a lot of foreign funds not accepting flows. I know that's a bit unfortunate, and hopefully, that the industry is working with the regulators to move the needle on that, because we definitely think that, international exposure is a very important element of every investor's portfolio, albeit obviously in a graded fashion like Kavita spoke about. So we do hope that, these limits will be enhanced, and, investors will be able to enjoy the benefits of international diversification. So with that, we really, really appreciate your time today.